Hi, everybody. It's Dr. Robinson. This is the May 13th, 2023 meeting of the Money Masters Investment Club. Not a lot to talk about. There are about 4 or 5 slides I don't want to go through real quick, but other than that, this will be a pretty short meeting. First thing we'll talk about is our result for the week. So as you can see, our results were pretty disappointing. Starting NAV on 5/6/23 was 26.19. We lost 38 cents for the week. Ending NAV 25.81. That comes to a 1.45% loss for the week. Now, I don't have I'm not going to make any excuses for why it happened. I am going to show you some of the things and I've had to deal with through the week and how I'm trying to solve that problem. And I think I have. Had a pretty good day yesterday towards the end of the day and in the beginning of the day as well. So yesterday was a pretty good day because we kind of had to do a strategy change on how to deal with what's going on in the market. So before we go any further, let me explain to you something that's going on in the market right now, and that is our trading volumes are very low. And it's not when I say our, I'm not talking about ours. I'm just talking about collectively as the market. The market, there's just not a lot of participants in the market. The volumes have been anemic. Now we look around for reasons why there's so many people not trading the market the way we'd normally trade it. And the only thing I can come up with, and I think it's a legitimate thing, is the debt crisis limit that's going on in DC between the president and Congress. Of course, we're running up against the debt limit, which means, of course, the Congress has to authorize the printing of more money for the government to keep going because they're running out of money. They're basically out of money. I think the drop dead date is June 1st. So after June 1st, they're not going to have any money to pay Social Security benefits and stuff. So there's a big problem on the horizon. The problem here is that the Republicans know that if we keep increasing the debt without ever cutting spending, we're just going to get into a financial position where we're virtually bankrupt. We're going to bankrupt the nation. We're getting close to that limit. You guys know what's coming on with Social Security in the next few years. In fact, Social Security has been in deficit spending since 2010. And a lot of people say incorrectly that Social Security spending doesn't increase the national debt. And of course, they're dead wrong. It absolutely increases the national debt because the money that is owed in Social Security has to come from somewhere. And the money in Social Security is gone. That money in the trust fund is gone. That's been used already. So the only thing they can do is redeem bonds, and you've got to redeem bonds by issuing new debt. And of course, they can't issue new debt after June 1st until the debt limit is raised. So the Republicans, in an effort to try to control spending a little bit, have come along and said they're not going to authorize raising the debt limit until Congress, the president and the Democrats in Congress agree to cut spending. Well, so far they've said they're not going to cut spending. So there's a fight between the Democrats who say they don't want to cut spending, just go ahead and increase the debt limit without cutting spending, and the Republicans who say we need to increase the debt limit because we have to, but we're going to cut spending in other areas. So there's a fight. And right now, I'm not sure who's going to cave. One of them's going to cave. Whether they're going to compromise or not, who knows, or to what extent they're going to compromise. But at the end of the day, there's a stalemate right now. And they've put off another decision. We were hoping last week they were going to get finished with this because time is running out. June 1st is kind of their drop dead date. They've pushed the meetings off until next week, so they start again on Monday, May 15th, to try to again come to some consensus on what to do. In the meantime, what does that have to do with the markets? Well, market participants have simply said they don't want to be in the market while this stuff is going on. Now, and remember, not everybody is a full investors. A lot of traders in the market, and that's what we are, by the way. But we trade a little bit differently than a lot of other traders. Most traders trade for maybe a week at a time, or 2 weeks, or even 3 months at a time. So what they do is they take a position, they hold it for a month, or they hold it for a couple of weeks, or maybe even a few days, and then they sell that position out. And that's fairly common. We do the same thing. It's just we don't do it over that length of time. We just do it the same day. We'll take a position on a Monday and get out of it by Monday. And we're just looking for a few pennies here and there, that type of thing on those transactions. And you know how this all works. So the funny thing is those traders are just not willing to come in the market where they're holding a position maybe for a week or 2 weeks or 3 weeks, simply because nobody knows what's going to happen in this debt crisis fight. And nobody wants to take a position and find out your position is 20, 30, 40% down now because Congress has said no, they're not going to raise the debt limit, which is going to make us go into default, or they're not going to cut spending, which means that we've kicked the can down the road again. So there's a lot of people out there who just aren't going to get involved. A lot of traders, I should say, not people. But there's a lot of traders out there who are just not going to take a position. That's caused the volumes overall in the market to be about 60% lower than they are traditionally. Having said that, what happens here is, remember I've told you guys or taught you guys over the years that the two things I like the most is I like high volume and volatility. Now, most investors don't like volatility. The volatility is measured in the stock market and through beta, and where the difference between the high and the low of a stock could be high. We like that because we can trade it both ways potentially. But a lot of investors, and think about this yourself, for your retirement stuff, you don't like to see a lot of beta. You don't want all that volatility. So we like volatility. Well, what we've been having here for the last week or so is a lot of volatility with very low volume. And that's not normal to us. And it confuses our algorithms a little bit and it kind of keeps us from really getting a good idea of what to do and what the market's trying to tell us at any one point in time. So I wanted to show you some charts from last week. Now, these are actual charts that I use to trade. I want to show you these charts and give you an idea of how much volatility you see in the market. Now, it's not immediately clear, but I do want to show you, we've been talking about it for the last few weeks now, these retracements that we're getting. So I wanted to show you these here real quick. Now, this is Monday. This is a chart for Monday. The shaded areas, if you look at the chart, just to kind of get your bearings, you see an 8 down there. Those are the numbers down there. That's just the time of the day. So the market, the American market's open at 9:30 Eastern time, and they close at 4 o'clock Eastern time. Of course, we use the military code here, so it's 1600 hours. So you can see that in the light gray areas, that's the pre-markets. That's where the futures guys trade. And then, of course, we have the post-market or after-market trading after 1600 or 4 o'clock. So we don't generally trade there. I do occasionally, but we mostly stay out of that. It can get expensive to trade in those markets because it's a little bit different when it comes to an ETF versus the market itself, but we're not going to get into that. What I want you to see, though, is that where the dark black background comes into play, you'll notice that my trend lines, which are the greens and the reds, and it shows up here as purple, but it's more red than anything. But you see my greens and reds kind of, those are the trend lines that we use to help me to decide which way the market's going to go. Overall, right at 9:30, the trend lines were down, so we knew the market was going to go down. So we took a position to go into the downside of the market. So we're basically buying puts at this point. Now, normally, you don't expect to see the market try to pop up on a down move. This is the trend line. The market's going to go down. Now, I'm not saying it goes down in a straight line. There's always going to be these ups and downs, but usually the ups are very small. But you'll notice here on this, and you can see that green arrow right at about 10 o'clock. So right in here, I have a thing I can turn on real quick. Let me see if I can get this to go. Right in there, you see that big green line. That's a retracement. That's what we talk about with retracements. So let me kind of give you an idea of what's happened. So if we got into a trade somewhere right in here at 9:30, and by the time it gets down to here, we might be up, let's say, 50,000. But this green arrow comes in, and it pops back up. And it might pop back up to say, so that our gains went from 50,000 to maybe 20,000. Now, overall, you still think, well, that's okay because we're still up 30,000 or actually 20,000 at this point. So yeah, we may have lost 30,000 on the up move, but we're still up 20. But here's the problem. The problem is because the chart is moving so violently, we don't know that this isn't going to be a trend reversal. So if the market, if this green arrow here, this green candle, we call them candles, if this green candle stays green like this, the thought here is the trend has actually changed to the upside and our algorithms just haven't caught it yet. So what happens here is that we end up making a stupid mistake. or we're kind of caught, and I shouldn't say a stupid mistake because we haven't made a mistake yet, but we're caught between a rock and a hard place. Do we exit the trade and pocket the 20 grand, which you never like to do? You know, if you were up 50 grand, you kind of want your 50 grand back. So we're hoping it goes back down and comes back down so that we can pocket the 50 grand and get out of the trade. The other side of it is, what happens if this green arrow, this green candle keeps going up? We're going to lose more, and eventually it's going to surpass where we got into the position, and we might be down 50,000. So at the end of the day, we have decisions to make. So to fix this, now this is where we've talked over the years about strangling a trade or trying to fix a trade. And one of the ways to fix a trade is through a strangle. So sometimes what we do is we buy calls on the belief that this thing is going up, because on this particular day, even though this chart here didn't change, some of our shorter charts did change. And the problem is, on this low volume like this, you don't know which chart to trust at the moment. Should I trust the long chart, which takes longer to turn? And if this is a change, this thing could go away from us in a hurry and we can end up losing a lot of money. Or should I trust the short chart and go ahead and buy calls? Well, on this particular day, on Monday, I went ahead and bought calls. I didn't want this to get too far away from us, so I went ahead and bought the calls. Unfortunately, by the time I got into the calls, it was about right here. So I bought calls right there, and then look what happened on the next candle. Now that candle did come up to about right here, and then it went back down. So now what's happened here is my original puts are still good, making money on those, but my calls now are losing money. And now I'm basically dragging these both positions down because I don't know which chart really I can trust, a shorter chart or the longer chart. And now I'm in a position where I'm going to start losing money if this thing continues to go the wrong way, or unless I get rid of one side of these. Well, the problem is sometimes you don't know which one to get rid of. And then you'll notice, and of course I got a bunch of stuff in there now, but you'll notice a couple of slides a little later. Let me erase some of those. You see some of the slides a little later, or the candles rather, a little later. Those green candles came back again. So we had a couple of red candles, we had a green candle, a red candle came back down. That's where I started thinking, uh-oh, now I've got these calls, should I cut them? And then look at the next candle. The next candle is green. Well, I don't want to cut the calls, because if this market is trying to turn up, I don't want to be holding puts. So I'm still holding the puts, and now I'm holding the calls, and I'm not sure which way to go, because none of these candles gives me an indication of which way to go. So what happens here is ultimately, and you can see this again in the next set of things that are moving on here. And I'm going to pull up my pen here again real quick. But in this next section, you see right here, the market trend has gone green. So at this point, the goal here is to cut the call, or the puts rather. So we get rid of the puts. We finally get rid of the puts. Now the puts have earned a bunch of money, and the good thing is we're pocketing the money. So we did pocket some of the money down here at the bottom, but now we've got calls. And the calls, remember we bought those previously kind of up in this area up here. Calls are underwater right now, so they're losing money. And we try to hold them until they can kind of get back up, and they do eventually get back up. But you'll notice the big red candle again. So we got another big red candle right here that kind of tells us the market wants to go back down. So again, we're in a position where we're not sure whether to cover again with to have some puts on board to protect us, or to let the thing keep going up. So at the end of the day, we struggle with this. And what's happened now, this day we ended up being okay on this Monday. I made money because I made money on the calls and the puts. I did have the puts. I did get rid of the puts down here at this bottom and ran the calls back up, and I did get rid of calls back up here. And then I kind of got out of the trade for a while because I was kind of thinking, wow, I felt like I got beaten up here a little bit. The charts, turns out the longer charts did help me kind of keep clarity on which way to go with this. But it's that first green candle in there that kind of confused me at first and didn't know what to do. And remember, the market is changing so fast that You don't have time. It's not like you can sit back and take 5 minutes to try to figure out what's going on. We have seconds. This thing can move so quickly that, in 2 or 3 seconds, you can be $30,000, $40,000 underwater. So we're trying to make sure we're not getting too far underwater, but trying to make sure we're following the trend and we know what the trend is. So we got a little messed up there, but we did find the clarity. The good news is the way to get out of this is that we held the puts down here until about 10:30, and then at 10:30 we cut the puts, bought and we already had the calls. We bought those up there, but we kept our calls, and our calls, they didn't make us any money, but they didn't lose us any money. And the reason I say they didn't make us any money is we bought them about right here, and we ended up selling them about right here. So basically, we got back to about neutral on the call. So the only money we made was from the puts. Now, the good news on this particular day, we made about $35,000. That wasn't much because I didn't do a big trade there, but we made about $35,000 on the puts there on that particular trade. We didn't make anything on the calls because the calls basically went from, they were negative maybe 35 or 40,000. I don't remember exactly the number, but they might have been negative 35,000. And then by the time they get down here to the bottom, they're at negative 35, and then they come back up, and they come back up to zero because there's no profit there. So at the end of the day, we don't make any money on the calls, but we had them for protection, and they kind of served their purpose in the confusion of which way is the market going to go. From there, you can kind of see, and again, I got a mess on the screen here right now, but you can see for the next couple of hours, the market just basically went sideways. There was no way to trade any of this other stuff during the lunch hour. Now, it's fairly common in the lunch hour for us not to be able to do a whole lot. The traders up in places like New York go to lunch, and the volume falls off even lower than what it's been traditionally or lately anyway. So it becomes harder and harder to figure out what the trend is or to take a chance, take a risk. Now, if you're only trading a few contracts, there's nothing wrong with trying to grab some in there. But at the end of the day, we don't. I personally don't trade small contracts. So when I'm doing multiple thousand contracts, I'm just not going to get in there and play games, trying to try to pull up 2 or 3 pennies like a lot of people do. It wasn't until later in the afternoon that we did finally, about 1 o'clock, we did finally see some clarity again. So we see again at 1 o'clock, the market wanted to go up. We did buy some calls there, and then we ran those for about almost an hour, give or take. And then you can see puts came back. Puts came back very big on that particular day. And the interesting thing is, and I was in on this day, and I was talking to some of the guys on our call that day. When we were doing this, I was in puts. I bought puts somewhere in this area up here, and they went down in a hurry. And I mean, they went down in a really big hurry. But you'll notice, and by the way, the trend lines are all down, so it should be puts. But to show you how chaotic this market is, the very next candle went all the way back. And it went all the way back up to here. So at the end of the day, there's such volatility. Now, what happened on this particular trade, by the way, because I was looking at my charts thinking, okay, the trend line has changed, all my charts were pointing down. So I'm thinking I could stay in the trade. I was up by this at this point $80,000. So I was up $80,000 in this particular trade, but this green candle comes, and again, it comes in out of the blue. Now I ended up finally cutting it loose because you see this green candle, it comes up so fast, it surprises you, and you're like, what the heck? So right then I'm only up about 40,000, and at that point I just hit the button exit the trade because I wanted to lock in. I couldn't tell. Now my gut instinct was it's going to come back down because the trend line had changed. But you'll notice that trend line only changed for just a few candles here. So I ended up taking a $40,000 gain here instead of the 80 because we're down there, and it turned on me so fast I couldn't catch it. And by the time I got out, we only had a $40,000 gain there. But according to the chart, it should have continued going down, but it didn't. It's that low volume here. Such low volume here, the trend can change in a heartbeat, and that's what it did here. And ultimately never did come back. I'm glad I took those gains, whatever gains, even though I only took half the gains I could have or wanted to, because it moved so fastly again or so quickly against me. sometimes you sit back and say, well, I've got 80 grand and it's not going to come back that fast. And even if it got to 40, I'm going to say, well, I'm still going to hold because it's going to come back down. And it never did. You can see it never did come back anywhere near those levels. So I'm glad we took the profits when we could. But that's the kind of week we've been having. And it's like that every day. In fact, let me erase this real quick and I'll show you a couple of other days here. And again, I'm not going to go into a lot of detail on these days. I don't want to bore you with this stuff. But it's been quite a week. And these charts the charts are doing a great job. It's just these retracements are so large and so devastating to us potentially at times that it just makes it really hard to deal with. This is a Tuesday chart, by the way. So you can see on Tuesday, again, you have a pretty simple chart. Now, again, I've expanded this a lot to make it look bigger than it is, but you can see a couple of things. First of all, you can see the trend change right in here. So this is telling us calls. And you can see the market did rise. It rose up to this level right here, and you got calls. Now, again, there's no change in the trend line, but notice the very next candle. That candle was so large, it went from where we were at, right here, to up here, and then all the way back down in one candle. Now, on this particular day, the problem here was this was such a big move that we ended up underwater in a hurry. This one, when we bought the calls, and I think I was up 25,000 on the calls or something. I don't remember the exact details. But on that very next candle, I was down, I want to say I was down 57,000. I don't remember the exact, but I think it was 57,000, give or take. So in a matter of two candles, I go from having some profits to being well underwater at 57,000. Now, again, when you're $57,000 underwater, the thought here is I've got to buy puts somewhere in here. And that's exactly what I did. So I ended up having to buy some puts. And on the puts, guess what happens? Comes right back up. So the puts are not going to work. The candles go back to green. But again, it kind of teases me a little bit. And the thing with these candles here, and you can see kind of those little tips or nips on the candles there. On the left-hand side, that's where the market went into that market on that particular candle, and on the right-hand side, it's where it exited the market. So on this candle here, let me erase some of the stuff here real quick so I can show you this a little bit more clearly. But for example, on this candle here, you can see where the entry was. I'm talking about the green candle here. And you can see the exit on the previous candle by there, that red one. It kind of red ended down there, and then the green candle opened there, went down. You can tell it went down first, and then came up, and then came back down a little bit and exited right there. And then the next candle entered right there, kind of went down, then went back up, and then exited right there. What happens here is you buy the puts, and that's what I did to protect ourselves from further losses. The market immediately spikes right back up. So the puts are out of the money, calls are back in the money. So we're gaining on the calls, losing on the puts, but we can't get rid of them right away because, again, you have a couple of candles. Even though they're green candles, you can see how big those retracements are. They're still coming down here towards this bottom. So you're still not quite sure, is this thing going to roll down further? So I don't want to cut my puts loose if the market if there's any risk of the market going down. Remember, puts protect us from a downward movement in the market. So I keep the puts, but I hold on to the calls. Well, whenever you're holding calls and puts at the same time, you're going to get yourself in trouble. There's something out there that we don't talk a lot about. It's called theta. Theta is the time value of an option. The longer you hold an option, especially when the market's kind of doing this up 10, down 10, up 10, down 10 thing, the longer it does that, the more value you lose in a theta. And the theta is part of how we calculate the value of an option. There's a mathematical formula called Black-Scholes. We're not going to go into Black-Scholes, that's high math. But when we talk about Black-Scholes, one of the things that goes into the calculation of the price of an option is theta. There's also delta and vega, some other things, but it's the theta that we pay a lot of attention to. And the theta has been high this week because of all the stupid stuff that's going on in Congress. So as that theta rises, it decreases the value of our option. So as we sit there and go up and down, where I can't get out of either trade because you don't know which way it's going to go, it just eats us up. So we end up losing money on the trade, even if the market goes in the right way. Now, ultimately, the market did go up, but because we had, again, you could see it again on this one, you have the green trend line going up, you're holding on to calls, and the next thing you know, you get this big downturn again. And again, it scares you from taking or getting rid of the puts. So it looks like on the charts, this should have been calls, and it was calls, but those retracements are so big, you can't get rid of your puts. So when you hold puts and calls for a long time, you're going to end up losing money on each side. Now, I ultimately, on this particular trade, in this particular batch, I made it up in the afternoon, I ended up losing about $30,000. So we had a good trade on that day before. First trade here, though, doesn't turn out well. I don't remember the exact amount. I think it's 36, maybe 35, $36,000 or whatever. So in the scheme of things, not that big of a loss compared to how much we're investing and stuff. So we've got a $36,000 loss. But then we have, you can see the trend line changed. So the trend line changed again. And again, we don't expect it to change this quickly. So here it changes again, right around here. So it's now going to be puts. So we're thinking in our head puts. So we buy some puts. And again, you get a big green candle in there. That's the stuff we're fighting here. So again, you buy puts, and depending on where you bought the puts, you're going to be up. The puts might have been worth $30,000 down here. So we might have been up $30,000 there, but on this candle here, we're only up maybe $10,000. So we've lost another $20,000 in value just from the retracement. And then the next candle comes back, and now we're back up to 30,000. So at this point, on this particular day, I went ahead and took the profits. And remember, originally, that original trade, we were down 35. But on this trade, we got 30 of it back. So now we're only 5 grand in the hole. So we're doing okay. And then it tells us calls. Again, we've got another trend change down here. It's telling us calls. We buy some calls and we get a good result. Market goes up. If I remember correctly, it's up about 40 grand or so. So we're up 40 grand and then it goes sideways. And then we have a couple of big red candles there. And this is where, and you can see it from these, you see my two trend lines there. They've kind of separated a little bit. The reason they've separated, there's 3 lines that I use, by the way. These are trend lines, and there's 3 of them. And whenever they separate, that tells you there's going to be a change. There's a change coming, or there's weakness in the market. It may not be a full change, but it tells me there's a weakness. You can see it at almost all of the turns, by the way, up there and right in there as well. So when you see some separation like that, that means that there's confusion in the market. Even back here in the calls at about 10, you saw some separation in the lines. That tells you there's weakness. Well, I see some weakness there. And again, I kind of fell for a head fake here. I thought the market was going back down. In fact, some of our shorter charts had already turned down. So we were thinking the market's going to go down. So I cut the calls loose, pocket the 40 grand, and buy some puts. And the puts, again, are working, and they're up about $10,000 here. And then this candle comes in and wipes me out. And that candle up there kind of ended it. So on this candle up here, we ended up losing about 25,000 because that one came out of the blue to us because it ended up being a head fake. We fell for the head fake. This is the kind of confusion we're having in the charts this week. Again, I don't want to belabor the point, but this is the stuff this is nightmare stuff. This is the stuff where we come back and say, maybe I should be a truck driver type of thing. This stuff is so confusing with the lack of volume and the high volatility in the market. The market is turning on a dime. Now, later in the week, I did tell you, I'll show you one more day, by the way, I'll show you on Wednesday, but later in the week, we did see this calming down a little bit. The volumes are starting to come back. So the volume on Thursday and Friday were actually not quite normal, but getting closer and closer to normal. So The market has calmed down, and that's why Thursday and Friday we had a little bit better days than we did on the first 3 days of the week. But Tuesday and Wednesday were especially the most difficult days for me. Wednesday was by far my most difficult day, and I'll show you why. And it was just, again, one simple trade that just put me underwater, and I couldn't get out of the trade, or I couldn't get out of it without basically taking a loss. So what I want to show you on this trade is, again, it starts out like any other day where the market is saying the market wants to go down, or the charts are telling us the market's going down. So the trend lines are all to the negative. So we get into some puts, but again, right here, you'll notice the big green candles. Now, when I got into the puts on this day, I didn't actually get in. I was a little bit late getting in. Wasn't any fault of, it's just I got distracted on something. I didn't get into the trade until about right here. So I got into the trade, and I'm immediately up pretty good. I bought 1,000 contracts on this particular trade, by the way. So I was up about $40,000 at this moment, thinking everything's okay. I did see this first green candle come up. You can see it right there. I did see it come, but I thought there's no way, because all of my charts, even my short charts, were still down. All of my charts were down. There was no way I was going to take this one seriously. There's no way this is going to be a retracement here. And look what it did. It went from, you can see that level here, 411.50, all the way up to this level up here, which is, let's call it 413.75 or something. So it went a lot further than I ever expected. I was, on this particular day, down about $90,000. When you're $90,000 down, and by the way, that means it was a $150,000 move, because I was $40,000 to the good side for a period, but then immediately $90,000 down. So this is a $150,000 swing. Well, when you're down $90,000, I have to buy calls. So what do? I buy the calls up in here somewhere. But they only worked for about a minute or two, and then the market went right back down. You can see the calls went back down, and they went down until about right here, where the calls started coming back. But the calls went all the way from here, where I bought them, down to here before they started coming back up. I had to buy puts again. So I had gotten rid of the puts from the original position because I bought the calls. I got back into puts. I got to protect myself again for a downward move. Puts are doing okay. Calls are getting beat up. So my losses are now on both sides. I'm going to get losses on both sides. Again, I'm still holding puts while the market's trying to go back up. The puts worked again coming back down, but by then my losses are so large that I basically have to exit the trade because I'm just making the things work. So on this particular day, and that's where most of our losses came in, I was down about 150,000 at the time, until about right here, by the way. So I was down 150 grand. That's not fun. So I don't care how you look at it. I don't care how much money you have. When you're down 150 grand, you got to sit back and say, what the heck am I doing here? So I took a time out for a bit. I ran my call. I did have my calls here. The downside here is I ran my calls all the way down here too. So I'm still holding calls and puts down here at the bottom. I finally got rid of the puts and said this isn't going to go any lower. It had gone all the way down to 409 on the market. And I'm out of the trade. I take the loss. I don't like to take it, but I took it. And then what I did is I went ahead and bought some calls. So I bought some calls, and I did not buy any puts with them. So out of the $150,000 loss, we did make some improvement, and we came back up about 75 grand total. Oops. So we ended up still with a loss that particular day, but we did. In fact, I think it was there was two trades in here. Actually my total loss for that day was about 40,000 net. So I actually made up more than that that I'm putting here, but I think I did it in 2 or 3 trades. But out of the $150,000 loss, we did bring it back, and our total loss was like $30,000 or $40,000 on that particular day. But this is the kind of charts we love. This is the way the charts normally look. This V thing here. These are easy to trade because there's none of those contra trades. There's none of those uh, retracements that go back down 40, 50, 60, a dollar, dollar and a half type of stuff. We don't see that in this normal. So the market actually started improving on Wednesday. The volume, by the way, you can see the volume numbers here. The volume was really low, especially in here. It was still low here, but it did improve. These gray areas down here at the bottom are my volume charts. But they did start improving up here. And I just had to, I was kind of desperate at that point. So it's like I got to buy calls and as many calls as I can buy, try to get back to some semblance of decency. But ultimately, that's what happened. So we did get back a bunch of our losses. But when you're sitting on $150,000 of losses, you're just you sit back and scratch your head and say, what the heck happened here? But it's this volatility in the morning, especially in the morning. It does calm down in the afternoon, but the stuff in the morning that's going on is really tough to deal with. It's really hard to see what the market's doing. So Thursday and Friday, I did go a little bit more conservatively, trying to kind of be more careful, especially in the morning with what's going on. Friday was the best day we had simply because I didn't fall for the head fakes this time. It was like, you know what, I made up my mind I was going to follow a certain chart, and I did follow that chart, even though, again, on Friday, and I don't have a Friday chart up, but on Friday, it was almost a repeat of this day, where those, your inputs, the market wants to go down, but after a few minutes here, you get a bunch of green candles and it pops up, and you start thinking, oh, do I need to do some calls? But I resisted the urge to buy calls. I was frustrated and I was worried, but ultimately the market did come back down, and we ended up making some profits on those on that position. So it did work out on Friday, and then Friday afternoon we had a pretty good time, or a pretty good day as well. So things did drastically improve on Friday. So Thursday and Friday were better days. Had to make up a bunch in the afternoon from the morning stuff. It's just the mornings are the volatility is so large that it's hard to know which way the market wants to go, even though our trend lines they're struggling. In all honesty, our trend lines are trying to tell us what the market's doing, but even on this, especially on this, I was telling you, whenever the lines separate a little bit, you can know that the market's kind of confused about something, or the market's trying to change, or the trend is trying to change and stuff. And again, you see that in this area here, where you see some splitting of the lines. You can see it up there. Now that we expected on the actual trend change, but it didn't happen the rest of the day. We had a little bit here where the market was a little bit confused, mostly because there was a candle here. It ended up gray. That just tells me it ended up neutral at over that period of time. Candles should be either red or green. If it's gray, it means there was no change in that particular candle. So there was a little bit of momentum loss there, but short of that, it's just been a wild week. One of the strangest weeks I've ever experienced. Some of the lowest volatility I've seen in more than a decade. I got to tell you, I've not seen volume and volatility this strange in a very long time. So I think we've got a handle on it. What I've done to kind of help you guys, or to put you at ease a little bit, what I've done is in addition to my charts, I've thrown on a shorter chart just to kind of keep me abreast of what's going on in terms of the short term. So if there is, when these green candles come up, they've got to show up somewhere. So maybe a 3-minute chart, a 5-minute chart stuff. So on Friday, I did use a 3-minute chart to tell me, kind of give me an early warning on where one of these things might come from. So if I'm just following my normal charts, and then my 3-minute chart kind of dings a bell and says, listen, this thing's trying to push up for right now, what I can do is, in this case, keep the puts. And let me explain to you how I would do this, by the way. So in the event that something happens where, let's say it's puts again, and I'm in puts because puts go down, but my computer, let's say a 3-minute chart might be a 2-minute chart or whatever, but if I get a warning here that the market is trying to push up, I can buy the calls up here or down here for the protection, so that even if the put or the market does go up, I'm not losing anything. I would be losing money on the puts. For example, let's say the puts were from the moment I bought them, let's say I bought them right here, and now they're down to here. I might be up, and I'm just going to throw some numbers up, I might be up 50 grand. But I've got this green candle to worry about. So on this early warning, if I buy the calls here, and let's say these calls go up 30,000, that's okay. Now it does mean I'm losing 30,000 here. So I would only be up 20K on the puts, but that's okay because I'd be up 30 grand on the calls. I'm still up 50 grand just like I was a minute ago. And then what happens here is once I see that early chart turn back down, which would be right there, I can go ahead and cut the calls, pocket the 30 grand. That's now guaranteed profits. I'm still in the puts. Now the puts are only worth 20 grand up here, but notice what the market's doing. It's going back down. So as the market comes back down, and ultimately that market came back down to here. So by down here, I might be up 80 grand. So between the two, I'm now up 110 grand potentially. So the thing that we're doing here is we just kind of did a short chart for those retracements. Now, are we going to be able to catch all retracements? I hope so. The hard part here is trying to figure out what kind of chart I can use because I don't want a chart that's so fast that you pick up every retracement because not every retracement needs to be dealt with. But I want to pick up the best or the biggest of the retracements. So right now, I kind of think it's a 3-minute chart. It might be a 5-minute chart. I'm still working on that. I used a 3-minute on Friday. The 3-minute worked fine, but I do want to kind of, and I'm going to spend some time on Saturday and Sunday going through charts because I do charts all the time. And I'm going to spend some time over the weekend on the charts, going through it and saying, would a 3-minute be better? Would a 5-minute be better? Maybe a 1-minute. Now, 1 minute would be so fast, you would pick up everything. So 1 minute is probably not it, but could be a 2-minute. So I used a 3 on Friday. The 3 on Friday helped me, and I saw what was coming, and it kept me out of the calls because it kind of implied that it wasn't going to be a big one, and it wasn't. It did come up, but it wasn't that big, and told me I could kind of ignore it. So I did ignore it. It did come up, and for a while I was frustrated because I was losing money, but it went right back down to where we were plus some. So we ended up in a good position. So I think we've dealt with it properly on these retracements, and I'm optimistic. So next week, whether the market goes back to normal volatility and volumes, I don't know. But if it does, that's great. We won't have to use these short charts for the retracements. But if it doesn't, if we want to have another week next week like we had last week, we're ready for it this time. So hopefully we won't come in here with any further losses. So having said that, guys, if you have any questions, I know I talked about a lot of technical stuff and some of the stuff makes sense to you and some of it doesn't. But if you have any questions about it, just give me a call, send me a text, whatever, and I'll be happy to answer your questions. But other than that, guys, we'll see you again next week. Have a good week.